Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. So we got to talk about the FOMC, Federal Reserve, Jerome Powell, right? The head of the U.S. Central Bank basically came out yesterday and said, hey, we're not hiking rates today. Or actually yesterday, didn't hike rates, kept them where they are. And released a statement which was quite similar to its September's meeting. And after the 2 p.m. statement that was released around 2:30, they had a press conference, and the press conference was very interesting there because that's where you got to really hear from Jerome Powell on where he thinks and where possibly the committee thinks where interest rates are headed towards, right? Because this is the hot topic that a lot of people are looking at. That, hey, where is the U.S. interest rates going towards? Are you done hiking rates, etc., etc.? So basically, to sum up, statement wasn't much. There wasn't much change there. You could argue, if there wasn't much change, that is maybe for some people hawkish. But to me, especially during the press conference, there was some signs where I felt that Jerome Powell is finally done hiking rates, at least this year, and they're basically in pause mode. And generally, when the U.S. Federal Reserve, right, or central banks go into pause, they usually don't go back to hiking again, right? Although we've seen that with some central banks, like, for example, Bank of Canada, right? Now, with a pause that comes in, it tends to last somewhere between maybe 6 to 8 months, right? So if we got a pause, and if the signals that we got on Wednesday that Jerome Powell is basically done, that could basically mean one thing only, that we're going to see rate cuts coming next, right? Unless inflation ramps up rapidly, because let's not forget, we have a lot of data coming up still. We've got 2 inflation reports, 2 jobs data. We got a job data that's coming out tomorrow, the US jobs data. We got another one in December. We got 2 inflation reports coming out. We got a lot of data points coming out. So you got a good set of them before December's meeting, before FOMC meets again in December. So, and the Fed mentioned that we're not, we're not saying we're done with inflation yet, although it is a good time to start thinking and slowing down and start thinking when we should basically stop and not hike further. And basically Jerome Powell mentioned this, and also mentioned that, we still have a lot of data before we figure out what we want to do. So from the press conference and from hearing Jerome Powell being asked a couple of questions, you could see he was pulling back from the hawkishness in September, especially when Jerome Powell came out and penciled in 2 rate hikes for this year. So they did do a rate hike, but basically he penciled in basically one more rate hike that was left for this year. And since the Fed didn't hike in November, that means, according to Jerome Powell's projections and dot plot, that means that the only meeting left is December for a rate hike. And the fact that in November he came out and just yesterday came out, started to kind of backpedal there and started to say that, hey, since September of what we talked about, whenever we have these projections that come out, first, these are individuals' opinions. Especially the projections and the dot plot and all of that. Second, especially after a couple of weeks and months after that meeting, the data, the opinions start to become stale, which means that we may not hold those same opinions that we had in September. So you had that kind of feeling, and you heard Jerome Powell kind of push back or kind of backpedal there, where he started to sound more on the dovish side of things rather than the hawkish side of things. And that's where you also saw stocks and bonds just rip and rally up higher and higher. And that's where also you got the headlines that came out also today that mortgage rates have come down to lower levels, come down from its peaks because bond yields are coming down. The long end bond yields are coming down. The short end bond yields are coming down. So bond prices are moving up and stock prices are also moving up, and they're all cheering since yesterday. So today and yesterday they've been going up because they're cheering on the whole idea that Jerome Powell is done, that this is the pause, right? Even though he still says that we have work to do on inflation, we can still come back and hike if needed. We still need to look at data. And then at the same time, while saying those same things, like every central bank has been saying, and also saying the same thing that we said in September, he also backpedaled and say that, it's time to think also, to slow down a bit, or whether how much further should we go on this rate hike. And we want to assess the data and everything that we're starting to see. Inflation has been coming down, but not to our levels just yet. So a little combination of both, which basically the market took it initially at 2 p.m. It was all over the place, very choppy, sell-off in equities. But then after 2:30, the press conference, you had initial choppiness. And then when they started to really get the dovishness from the Fed, then it was just ripping all the way to new highs on the day and also today as well. So the markets as a whole, also when you look at what the markets are pricing in, they're basically pricing in a very low probability. I think last when I checked, less than 20% probability that they're going to do a rate hike, another hike in December. So, as long as inflation and data, we've been seeing some data, like for example, ADP come in weaker than expected. We had the JOLTS number and we're going to get the jobs number tomorrow. If these numbers continue to come in weaker, if next inflation report comes in weaker or in line, and the December number as well, 100% you're not getting the hike in December, right? What happens next year? I mean, we will see. We'll see what happens then, right? But I do want to say that when you look at history, generally the Fed goes from hiking, quantitative tightening, to then pause for a couple of months, see, what's happening, because it takes time for the data to affect the economy. And then from there, 6 to 8 months, maybe a year of a pause, then they start cutting. So you could expect, where could you say the pause really started from? You could argue September, October, right? So let's just choose October, right? So October, November, December, January, February, March. So starting March is where, you could get the market starting to price in that a rate cut is going to come soon, right? It could be from March and onwards. It could be March. It could be, June. It could be September. The markets are right now pricing in that June or September time, we're going to start to see some rate cuts. Now, if you think about it, why would they do rate cuts, especially if inflation has not been solved yet, right? Especially we still got supply chain issues, especially because there's inventory issues, especially because there's chip issues, there's war, and oil prices are still elevated, food prices are still elevated, wages are high up there, right? We still haven't seen anything major. It makes me think that the markets are pricing in or possibly predicting that in the next 6 to 8 months, you are probably going to get some sort of credit event, some sort of crash that brings inflation lower, and then you get the rate cuts to come in, right? So this pause component of things, the pause that the Fed is doing is still creating stress and tightness because they're still doing QT, they're still creating tightening conditions, and they're not cutting in any sense, so they're still keeping conditions tight. And of course, if inflation picks up, they can change their minds and go back to hiking rates. But, the pause alone can still create some tightening conditions where, like I said in the previous videos as well, that when renewals come in and those rates are not down, it's going to create pain, right? Commercial real estate, residential real estate, loans, etc., etc. You can expect pain around there. And if the pause stays longer than anticipated, then sure, you're going to see slowdown in the growth, in the economy, in the data, in earnings. You're going to see layoffs, and it's all going to pile into this event, right? So really what I'm expecting from all of this, and what I'm hearing from, especially hearing from the Fed, is that it feels like that they're in pause mode here and that they're done hiking rates unless, again, inflation ramps up. But, I think they're basically done. And then what happens here next is the cut. And the cut comes because of some sort of credit event or something that really, really messes up the economy. Could I be wrong? Sure. Slight chance of a soft landing is a possibility. And could they cut? And you get, the markets still going up and nothing breaking, no layoffs and so on, and inflation comes below 2% with no credit event. Sure, that's a possibility. That's your Goldilocks scenario. I don't fall into that category. I think that we do see some sort of credit event, no soft landing, more of a hard landing, no Goldilocks. We see a hard recession that comes maybe in 6 months to a year from now, and we're going to see asset prices and the stock market react to that. And especially when the stock market drops, and if it drops, and you get that, let's say 30% drop or whatever, then you're going to expect the Fed to come and intervene and do something about it, especially when there's panic in the markets and the economy. So that's my overall take on the FOMC meeting. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.